The EMI trap. Nobody escapes. Every month, your salary disappears before you even notice. Home loan, car payments, credit cards, school fees. You think you're building wealth, but each EMI silently controls your life. Most never see it coming. Discover how the middle-class dream quietly traps your freedom and what you must do to regain control. Every month, millions of people experience the same silent ritual. Salary enters the bank account, and within hours it disappears into scheduled deductions. Home loan installments, car payments, credit card bills, personal loans, school fees, subscriptions. What remains is not wealth, but survival money. This cycle repeats for years, sometimes decades, until repayment becomes the central structure of life itself. This is the EMI trap, and it does not feel like a trap when you enter it. It feels like progress. The modern financial system has redefined ownership. In previous generations, people bought what they could afford. Today, people finance what they cannot. Easy monthly installments make large purchases appear accessible. Instead of asking whether something is affordable in total, the only question becomes whether the monthly payment fits into current income. This subtle shift transforms financial decision-making. It moves focus from long-term burden to short-term comfort. EMI structures are psychologically engineered. A large number like 20 million feels impossible, but a monthly figure broken into manageable installments feels reasonable. The brain discounts the future cost because the immediate burden appears small. Behavioral economics explains this as present bias. Humans overvalue present convenience and undervalue future obligations. Banks and financial institutions understand this deeply. Marketing does not emphasize total repayment with interest across 20 years. It emphasizes the monthly amount. The number is designed to feel harmless. The danger is not in one EMI. The danger is in cumulative dependency. A home loan may seem manageable. Add a car loan, a personal loan for interiors, a credit card installment for electronics, and recurring subscription services, and the structure becomes rigid. Income is pre-allocated before it even arrives. Financial flexibility disappears. Every decision begins revolving around maintaining cash flow stability. The trap tightens when income rises. Promotions often justify bigger commitments. A salary increase encourages upgrading the house, the car, the lifestyle. Each upgrade adds a new installment. Instead of using higher income to create freedom, it gets used to increase obligations. This is known as lifestyle inflation, and EMIs accelerate it. The system rewards expansion, not restraint. The middle class is particularly vulnerable. It seeks stability and social validation simultaneously. Property ownership symbolizes security. A car represents mobility and status. A well-furnished home reflects success. Society celebrates these milestones. Rarely does it analyze the cost of tying 20 or 30 years of future labor to a financial contract. The applause hides the pressure. An EMI is not just a payment. It is a commitment of future time. When someone signs a 20-year home loan, they are not simply borrowing money. They are pledging 2 decades of consistent income. That assumption carries risk because income is not guaranteed. Job markets change. Industries evolve. Automation disrupts roles. Health emergencies occur. The EMI does not adapt to uncertainty. It demands fixed consistency in an unpredictable world. This fixed obligation alters career behavior. Risk tolerance decreases dramatically. Entrepreneurship becomes frightening because irregular income cannot sustain fixed payments. Career shifts become risky. Negotiation power weakens because the fear of losing steady salary grows. Even toxic work environments become tolerable when the alternative threatens repayment schedules. The EMI becomes an invisible employer. The psychological weight of long-term debt is rarely discussed openly. Financial stress does not always appear dramatic. It manifests subtly through constant low-level anxiety. Every unexpected expense feels threatening. Medical bills, repairs, economic slowdowns, layoffs. Instead of opportunity, uncertainty becomes danger. The brain remains in protective mode. The marketing narrative suggests that real estate always appreciates and therefore justifies the burden. However, appreciation is not guaranteed in every market or time frame. Even when property value rises, liquidity remains limited. You cannot easily sell a primary residence without disrupting your life. Paper gains do not equal cash freedom. Meanwhile, interest payments across decades significantly increase total cost beyond original price. The EMI trap is reinforced by social comparison. When peers upgrade homes or vehicles, standing still feels like falling behind. Social media intensifies this perception. Curated images create the illusion that everyone is progressing upward. The fear of missing out pushes individuals to commit financially beyond comfort. Easy financing provides the mechanism. Another overlooked dimension is opportunity cost. Money allocated to long-term EMIs cannot be invested flexibly elsewhere. It cannot easily fund new ventures, alternative investments, skill development, or geographical mobility. The repayment structure locks capital into one asset category, reducing diversification. Overconcentration increases vulnerability. Debt itself is not inherently evil. Strategic leverage can accelerate wealth when managed intelligently and paired with appreciating assets and strong cash flow. The problem arises when debt is consumed rather than invested, and when repayment capacity depends entirely on salary. When debt removes flexibility instead of creating opportunity, it becomes a cage. The phrase building equity often justifies long mortgages. While equity accumulates gradually, early years of repayment primarily service interest. The bank earns first. The borrower gains slowly. Understanding amortization reveals that true ownership grows slowly in the beginning and accelerates later. Many borrowers are unaware of this structure when signing agreements. Financial freedom is not defined by asset ownership alone. It is defined by control over time and decisions. When fixed obligations dominate income, control decreases. The EMI trap quietly exchanges autonomy for perceived stability. Escaping does not start with dramatic action. It begins with awareness. The realization that monthly affordability is not equal to long-term sustainability is the first shift. Evaluating total repayment, stress tolerance, income stability, and opportunity cost is essential before committing to long-term contracts. The deeper question is not whether one can afford the EMI today. It is whether one wants to design life around servicing debt tomorrow. When financial structure dictates career, lifestyle, and risk appetite, freedom becomes conditional. The EMI trap persists because it aligns with cultural definitions of success. It rewards visible achievement while concealing structural dependency. It promises ownership while extending repayment timelines across prime working years. Understanding this system does not require rejecting property or credit entirely. It requires clarity. It requires distinguishing between strategic leverage and emotional consumption. It requires calculating not only monetary cost, but psychological cost. Most importantly, it requires recognizing that long-term debt changes behavior. It narrows options. It increases fear. It anchors life decisions to repayment schedules. That is why so many people feel stuck despite rising incomes. The trap is not about poverty. It is about restricted mobility. It is about designing a life where escape becomes difficult, not because of physical barriers, but because obligations multiply quietly. And once the structure solidifies, reversing it demands discipline far greater than the one used to enter it. The EMI trap does not begin with a signature on a loan document. It begins much earlier, in conditioning. From a young age, financial success is presented in visible symbols. A house represents stability. A car represents achievement. A furnished home represents responsibility. These ideas are repeated by families, institutions, advertising campaigns, and social norms. By the time an individual begins earning, the blueprint of success is already installed. The system does not force anyone into debt. It simply makes debt appear rational, normal, and even admirable. When interest rates are marketed as low and approval processes are simplified, borrowing feels effortless. Digital banking has reduced friction. Loans can be sanctioned within hours. Credit limits expand automatically. Financial products are pre-approved before individuals evaluate whether they are necessary. This convenience removes the pause that once protected people from impulsive long-term commitments. The older generation often saved for years before making major purchases. The waiting period created reflection. Today, the waiting period is replaced by instant eligibility. Immediate access compresses decision-making time, and shorter decision cycles increase the probability of long-term obligations. Another mechanism reinforcing the trap is income predictability bias. Many people assume that their current salary trajectory will continue upward steadily. They project future promotions, bonuses, and increments as guaranteed. Loan calculations are based on optimistic assumptions rather than conservative estimates. When economic downturns or unexpected disruptions occur, the gap between projection and reality becomes stressful. Employment structures amplify vulnerability. Modern careers rarely offer lifelong security. Industries transform quickly due to technology, automation, and global competition. However, EMI commitments often extend for 20 or 30 years. There's a mismatch between income stability and debt duration. Short-term employment certainty is being used to justify long-term financial rigidity. Inflation adds another layer. As living costs rise, even fixed EMIs begin consuming a larger proportion of real income. Although the installment amount remains numerically constant, purchasing power declines. What felt comfortable initially may feel heavy years later. Without significant income growth, pressure accumulates gradually. Social proof intensifies the cycle. When peers purchase property or upgrade vehicles, it reinforces the belief that participation is necessary to remain competitive or respectable. Rarely do people publicly share the stress behind these commitments. The narrative remains aspirational. Observing only outcomes without context distorts perception. Individuals compare their internal doubts with others' external celebrations. Escaping the EMI trap does not require extreme rebellion or abandoning ambition. It requires structural recalibration. The first step is financial clarity. This means calculating total outstanding debt, total interest payable over remaining tenure, and percentage of income committed to fixed obligations. Many people know their monthly installment but have never calculated cumulative future cost. Seeing the full number alters perspective. The second step is building liquidity before expansion. Liquidity provides psychological safety. An emergency fund covering at least 6 to 12 months of essential expenses reduces dependency fear. Without liquidity, every EMI becomes urgent. With liquidity, decision-making regains calmness. This buffer does not eliminate debt, but it restores negotiating power in career and life choices. The third step is preventing EMI stacking. One long-term obligation may be manageable. Multiple overlapping obligations create compression. Before adding new installments, it is essential to evaluate whether flexibility decreases significantly. Delaying upgrades until previous debts reduce can maintain breathing space. Lifestyle pacing is more powerful than rapid accumulation. Prepayment strategy deserves attention. Many loans allow partial prepayment without heavy penalties. Directing surplus income toward principal reduction shortens tenure and reduces total interest burden. Even small additional payments early in the tenure significantly impact long-term cost because interest calculations are front-loaded. Understanding amortization empowers smarter repayment decisions. Income diversification is another protective layer. When salary is the only source of cash flow, risk concentration increases. Developing secondary income streams, whether through investments, freelance work, digital assets, or business ventures, reduces dependency on one employer. Diversification does not require immediate scale. Even modest alternative income can offset partial EMI burden and provide psychological leverage. Asset evaluation is equally important. Not all finance purchases contribute to long-term stability. Distinguishing between appreciating, neutral, and depreciating assets changes strategy. A primary residence may hold emotional value, but it is not automatically a productive asset unless it generates cash flow or significant depreciation. Vehicles and electronics typically depreciate rapidly. Financing depreciating assets increases long-term cost without corresponding wealth growth. Mindset transformation is critical. Ownership should be defined by control, not possession. If an asset controls behavior and restricts choice, it functions as a liability regardless of its market value. Reframing success around flexibility rather than display reduces social pressure. When external validation loses priority, financial decisions become rational rather than performative. Another practical strategy is renegotiation. Interest rate revisions, refinancing options, or balance transfers can reduce burden when market conditions shift. Many borrowers remain passive after signing contracts, assuming terms are fixed permanently. Proactive management of debt improves outcomes. Financial literacy turns a static obligation into a manageable structure. Downsizing, though emotionally difficult, can sometimes accelerate freedom. Selling a high-burden property to purchase a smaller, more affordable one may reduce long-term stress significantly. This decision challenges ego and social perception, but can restore mobility. The objective is not maximal ownership, but sustainable ownership. Time horizon awareness changes everything. When evaluating any EMI, projecting life stages over the tenure reveals hidden trade-offs. Consider career transitions, children's education costs, health considerations, and evolving aspirations. A rigid 20-year commitment should align with realistic long-term plans. If uncertainty dominates, shorter obligations preserve adaptability. The ultimate escape from the EMI trap is not necessarily complete debt elimination, though that remains ideal for many. The true escape is regaining optionality. Optionality means the ability to say no to undesirable work, to pivot industries, to relocate, to take calculated risks, or to pause temporarily without panic. Debt that removes optionality becomes a prison. Debt that coexists with optionality remains a tool. Financial systems are unlikely to change their design. Easy credit will continue expanding. Marketing will continue highlighting affordability over total cost. Social validation will continue rewarding visible assets. Therefore, responsibility shifts to individual awareness. Before committing to any new EMI, a simple framework can prevent future regret. Evaluate total cost over tenure, calculate worst-case income scenarios, ensure adequate liquidity, limit cumulative fixed obligations, and prioritize flexibility over display. If the commitment passes these filters, it may serve long-term goals. If it fails, delay becomes strength rather than weakness. Freedom is not the absence of ambition, it is the presence of choice. The EMI trap thrives when choices shrink silently. Breaking the cycle requires intentional design instead of automatic participation. Most people will continue following the standard path because it feels safe and socially approved. Escaping does not require dramatic isolation from society. It requires internal clarity, stronger than external pressure. The question is not whether EMIs are inherently bad. The question is whether they are serving your future or consuming it. When debt finances growth, skills, or productive assets aligned with long-term strategy, it can accelerate progress. When it finances lifestyle inflation driven by comparison, it extends dependency. Nobody physically locks you into the EMI trap. The bars are built from assumptions about success, fear of missing out, and optimism about stable income. Once recognized, those bars become visible, and once visible, they can be dismantled piece by piece through disciplined restructuring, patient reduction, and deliberate financial design. Escape is possible. It is simply quieter and slower than the entry.